All righty, Diane, thank you very much. And with me, Neil Bader. He's the Chief Executive Officer of Skyscrape Mortgage Company. And boy, these numbers that come out today, blockbuster figures, the home sales just continue to go through the roof, so to speak.
Home sale figures continue to exceed expectations. We've seen that, I think, 3 quarters in a row now. I think the good weather has obviously had an impact on it,
Sure.
Except in the Midwest where we saw the numbers a little lower. But generally speaking, the consumer confidence just is driving the market.
Right. Everybody out there thinking that the jobs are secure. There's plenty of money floating around. The wealth effect, I suppose, from the stock market. All those are positives for the home market. How about mortgage rates? We've been enjoying very low mortgage rates, no doubt a factor in people's decisions to upgrade or even to jump in for the first time. Now with bond market yields going a little bit higher, is this going to have a dampening effect on this market?
Well, I don't think it'll have a dampening effect on the market, but certainly we're going to see a shift in the type of mortgages that people should be looking at because, we've really seen probably a 50 or 60 basis point increase in the long bond recently. Sure. And what that means to the average mortgage consumer is the following. I mean, as recently as a week ago, we had, jumbo 30-year fixed rate mortgages probably hovering around 7%, maybe 7 1/8. I think that when the rates come out today at about 11.30 or 12 for most the major lender wholesale rates, we're going to see 30-year fixed rate jumbo money for the first time in a long time be over 7.5%, probably about 7 5/8. What's interesting is that the 30-year fixed rates, however, tend to be unusually sensitive to market conditions, whereas a lot of the long-term adjustables are not as sensitive. So it's not that there won't be cheap rate financing available in the marketplace, but I think what people need to start to do is to shift from the 30-year, maybe look at the 5-year adjustable, the 7-year adjustable, the 10. 5-year money, as of yesterday, was still as low as 6 1/4. Well, that's
Sure.
a huge difference.
And those adjustable rates as well. I mean, the expectation is that maybe the economy is going to be too strong, that maybe the Fed will get into more of a bias towards lifting rates, but nobody's really expecting at this point that those short-term rates are going to be jacked up much.
Right, and you don't see the adjustables, certainly, even if the short-term rates start to come up. The banks are taking less risk because they're locking it in for a shorter period of time. So unless there's a real movement in the market or a real consensus that they feel that the market rates are going to be higher, you don't see the same sensitivity. 30-year fixed, I mean, you can literally follow the long bond, and you'll see those rates bump all over the place. But that spread, as recently as a week or two ago, the spread between 5-year money and 30-year money on the mortgage rates was maybe 0.5%. Today you're looking at 1.5%, so those become particularly compelling.
All right, we'll leave it at that. A lot of activity on that home front, mortgage front. Neil Bader, Chief Executive Officer of Skyscrape Mortgage. I'm Jim Kingsland.